traders, Gary Wagner here, just after 10 o'clock in Honolulu, 3 o'clock in New York on Friday. Happy Aloha Friday, as we say on the islands. Last day of February, the 28th, 2014, and this is the daily report for gold and silver. Although well off of their lows, we do have the precious metals complex under pressure, everything except for palladium today. Current print on the screen, as you can see, 1325 and change. That is on our spot market. Continuous contract COMEX gold currently trading at 1326. The low today in cash has been 1930, the high 3420. And as I said, current print is roughly 1326, putting it off about $5 on the day. Silver also trading lower off on the day, but off of the lows being $21 even. Current print, as you can see on the screen, 21.17, high 21.49. Current print for continuous contract of COMEX silver 21.25. Traders, we have a lot to cover on today's show. I want to cover three primary things. First thing, I want to talk about the week in review itself. Secondly, I want to talk about the trade that we just got out of. And then lastly, I want to look at our forecast for next week or the next couple of weeks. First of all, to our trade, we did exit our long gold position, and we exited yesterday as our stop was hit roughly in this area, about 1325. To review the trade itself, we really want to look at another chart that's going to show us the breakout, and then look at this ascent right here. Now, traders, we entered the trade roughly a couple of weeks ago. We entered the trade at 1258 was my first signal. That was an aggressive call, and the following day I sent out a conservative call. Traders that took the aggressive call got in at 1258, 1266 for the conservative call. And what we were looking at was a combination of factors, and that's really what triggers all of our buy signals or sell signals. The primary factor that we were looking at was based on two parameters. One, this long-standing resistance line that we talked about, because we had etched in stone by these series of tops right in here a trend line showing us how this market was moving down, but more importantly, it showed us as we did rally whether or not we had broken out of this dramatic bear trend. And so we can see the first real attempt came last year, June, July, but it stalled right at that line. Market then comes down to about 1265, as we've talked about, comes up and then stalls again right here. So this time when the market came down, the first thing that we saw that was a little bit different than what we had seen in the past was the fact that we were matching these lows here, meaning the low that we got at 1181 back last year with the most current sets of lows, and we hit this bottom twice, I believe 1181, 1186, roughly in that area. Now, we could have entered at that point. We did not, because my sense was that as this market came up, until we broke through this long-standing resistance line, we could in fact see the market come up and then simply trade lower. However, that was not to be the case. And what we saw that was different on this particular rally was as the market came and rallied, it actually broke above. We had no signal there because the following week it traded really roughly in that area. But as soon as it broke above this line, and you can see that this area right here is 1262. As I said, we got in at about 1258. Let's go ahead and blow this up so we can get a better indication of what we're talking about. There we go. And as this market came up in this area, it really didn't just immediately break out as I had anticipated it might. We had this week in which we had dramatic closes above that area, but we also had points in which it was trading just at and below. So it wasn't really until we saw the market break solidly above this line where we generated our buy signal. And here's 43, here's 62, 60. So our buy signal was basically generated, let's line this up as straight as I can, was generated right in here as we broke above that line and started seeing this dramatic move. Now, the other thing that's absolutely noteworthy when we look at a chart from this level is that once the market did break, it broke dramatically and broke rather hard. Now, that was our entry. In terms of our exit, what we did is we used our series of trailing stops, because although we had initially pegged the top, you can see this horizontal line here. It is not a Fibonacci based line. It's based on some Fibonacci work, but this was basically our upper level target, and we were looking for a move. We wanted to capture a move somewhere in between this area. In other words, the area from the point in which it broke out to the market, if it was going to rise to about 1329. Now, the market actually rose to, I believe it was 1345, 1346 in that area, but the key was this. What we did was we raised our stops as the market moved up. So the last couple of stops, once this market really started moving up, and it moved up above 1306, 1307, which was a resistance area I was looking at. Once we overtook that, we placed our stop just below this point right in here. And then as the market trended higher, we just simply kept raising our stop. I put out a trade recommendation as the market came up right in here. Here's 29, that some traders might simply want to just pull their profits, take their money and run. However, it was our recommendation at that point that what we thought would be the best of strategies would be to trail the stop up. So on the following day, what we did is call this 1326 here. We actually rose our stop to just below 1326. That would be right here. And ever so merrily and gently, as I said on yesterday's show, I really do expect this stop to get hit today or tomorrow. It in fact got hit early in the morning trade. So in essence, when we take a look at this trade, we're in at, I call it 62 because that's our average right here. We're in at 62 and we were out at 26. So we were able to capture a pretty good percentage of this overall move. This being the entire move that we were looking at. We probably caught, 2/3 of the move. And my philosophy in trading is this: we never know when the big moves are going to happen. And what I do know is that being positioned properly on the right side of the fence when the big moves happen is the first step that we have to capture profits. The second step that we really have to have when we capture profits, of course, is knowing how to ride that wave. And being out in Hawaii and watching the surfers all the time, to me, catching these large trends is very, very much like these large wave riders in that they've got to aggressively swim out to position themselves to where that wave is going to come and then be ready once the wave comes to ride the power of the wave. In the same way, I believe that what we do when we catch these big trends is we position ourselves in front of the trends. We're not sure when that big wave's going to come, but when it comes, we need to be in a place so that we can take advantage of it. Now, that's the first thing. The second thing is watching those surfers ride into shore. They expend a tremendous amount of energy as that wave tends to wane a little bit, kind of riding the last of the power. And the way that we do that is by simply trailing stops up. So initially when we went into this position, we had our stop way under. I believe our stop was sitting under 45 because I was looking to account for these series of lows. And then in essence, we just raised it up along the Fibonacci scale. And that allowed us to capture a good percentage of the profits. And so in essence, I feel we have a really, really solid trade under our belts. I feel terrible about the fact that we had a drawdown at the beginning of the year, but we're in profits for the year. And the most important thing is that I absolutely, with all of my heart, believe that profitable traders are profitable because they can catch these big trades, and those big trades will account for a vast majority of the overall annual profits. We just finished putting together our track record for the last 4 years, profits every year. But if you look deeply into it, you have a series of winners and losers. We're batting about 60-70% correct, but you have a series of winners or losers, and most importantly, it's being able to ride the winners that are absolute trends. And I can tell you this, that what really made last year significant for us, let's go ahead and move this back, what made last year significant, because realize that we made money in a market that lost 30%, but we basically went long on 90% of our trades. It was catching these big trades, this being the biggest. We were able to slice out a good percentage of this trade. On this one, well, the cat's still not out of the bag because the market could head higher. It's trading at 27, and that's what I want to talk about next. Simply put, what are we looking for this market to go to, and what is our current strategy? So the first thing that we want to look at in terms of current strategy is actually get a sense for how the week looked itself. And to do that, let's go ahead and pull up a weekly chart. Now, of course, when we pull up our weekly chart, we can see in terms of, it's Japanese average chart, of course, but we can see in terms of body size is smaller, but it's still a decent body size. Realize that Japanese average charts lag behind. The information we get lags behind what we'll get in a standard candlestick chart because of the fact that they're derived by comparing the range today with the midpoint of the prior candle. But we have an absence of lower tails, and that's what's important when we look at these uptrends, because typically in an uptrend, you will have the absence of these lower wicks, and what that means is it never traded into or lower than the midpoint of the prior candle. And typically, we're going to have to actually kind of move these candles, kind of tighten them up a little bit so you'll get a better indication of what I'm talking about. Let's go ahead and thin these out. But typically, what you get is as you get to the top of a market, you get the tails showing up again, the lower tails, and you also get a very, very small body size, as you can see right here. I call that a doji-esque or a pivotal doji type candle that you typically get on the tops as well as the bottoms. They're genuinely great indicators of those pivot points. So we get this breakout here. We have a week that has really been a dynamic week, and to get a real sense for the week, what we need to do, of course, is to convert it back to a standard candlestick chart, and it gives us a much bigger picture. Because, as I said, you get a huge lag in the marketplace when you look at the Japanese average charts, but they give you a defined idea of overall trend. And on the weekly charts, when we look at it, what you can see is that we've had the last 2 weeks have absolutely been up weeks. What I mean by an up week, simply put, is that it opened on Monday and closed higher by Friday. That's the greenness in this candle. Red candle simply means that this is your opening price on Monday and your closing price on Friday, and it's lower. However, even though they're green, they are very much doji candles, meaning the open and close are very, very close. And what that says in terms of the philosophy behind candlestick identification and pattern analysis is that neither the bulls nor the bears have absolute control. And it's quite easy to see, because take a week like we had 3 weeks ago in which we had that dramatic rise right here. The bulls began the week just above this retracement line that we've identified and closed it substantially higher, tremendous range, and it closes near the upper end of the range. Now, contrast that, or compare that, I should say, to these two candles in which you've had these higher highs made this week. In other words, gold closes, here's our high, next week new high, next week new high. We're at a 4-month high, because you really have to go back to November before you see these highs, and we've now really surpassed these highs or just come real close to them. But we're at a new 4-month high. However, we're doing it as we're running out of steam. And my sense is that we're probably going to see a little bit of weakness come into the market. That's why we tightened that stop up in the way we did. And my sense is next week, I wouldn't be surprised to see lower pricing. However, there's a couple of wild cards, a couple of caveats. Big caveat is what's going on in Ukraine. So there's some uncertainty in the market, and the macroeconomics are still not dramatically improved. However, we do have a substantially higher stock market this week. I believe that's gone to record highs. So what's our strategy, and what are we looking for? Well, as I said, I am looking for the potential of us seeing some lower pricing in the marketplace. And the way that will determine where it's safe to kind of re-enter the market, here you can see the market is trying to recoup. It's back at 27. What did we say the low was? About 21. But the key is this. If we take a look at this move from 1181 all the way up to this top, and this top is at about 1345, and we look at different retracement levels, what you'll see is 1306 is a 23% retracement level. It's pretty significant. So market spikes up. It hits actually the 1329, and although this horizontal line is not Fibonacci based, I just put that in as our target. There are numbers on other charts, and our daily viewers who look at our charts every day are well aware of where we pulled those numbers from. We saw the market come down 23%. Market moves back up, exceeds that, comes and makes these lows. And so what we're getting right now, I believe, is an area in which the market is either building a base to consolidate, and to do that, it's going to probably still need to make some new lows and kind of band in this area. However, when you get really, really strong markets, it's really characterized by these huge spikes, dramatic sell-off, huge spikes, dramatic sell-off. You can see that this market really teeter-totters all the way up until we break through this resistance area. Resistance area takes us really to an upper level resistance that we get, and then begins to back off here and back off here, because look, that's the first time we have seen this type of activity since this market started to rise. So the following is my basic forecast for the next week to 2 weeks. And of course, this model will change if we continue to break to the upside at the beginning of the week. But as it stands right now, the way that I look at our basic Elliott wave count, we had this genuinely dramatic long wave 3 down, took us from 1800 down to 1181. We get our fourth wave that was comprised of an A, a B, and a C, and this is our intermediate count, of course, and that gave us wave 4. We then went into wave 5. Wave 5 consisted of a 1 count, a 2 count. We came into our 3 count. We matched the bottom here, and we had a model in place. It's basically a bear market truncation. We looked at that particular model as an effective model if, in fact, we broke above this. Because if the market simply traded down, came back up, hit this line, and moved back down, this would be wave 3, wave 4, and this would be 5 of 5. It would be a complete Elliott 5 count down on our final 5th wave. But that wasn't the way this market unfolded. It broke dramatically through that long-standing resistance line, telling us that what we were probably looking at of the two models was that bear market truncation. Market came down a little bit right in there. That's probably, in terms of a subcount, we'd get a wave in there. And then we had the market move to a genuine resistance area. And that resistance area is still below these series of tops, but it is those tops that I want to look at. And let's go ahead and kind of thin this chart out so we can get a better idea. You can see how the market kind of moved along this line and then broke above it. We now have, in terms of where I'm pegging our current resistance, is going to be based on a couple of tops. This top right in here, 1365, and then 1435 right in here. And so my forecast, what I believe we might see is we've just gotten our A. Could trade a little higher, could trade even as high as 65 if it doesn't bail out here. We're going to get some sort of a B. And then our final C is going to be the wave that actually goes in and threatens or takes out, first of all, this 1365 resistance area. And the next real strong resistance area has got to be right here at around 1435. Now, traders, of course, silver. Silver has absolutely been a different animal. It's been a different animal in that we looked at the same type of series of lows for some sort of idea of a breakout, But when gold broke, which was right in this area right in here, we saw silver kind of meander around. Now, you can see we've absolutely had that breakout. We've hit our upper level resistance of 22. My belief is that we'll see a similar kind of activity. If we see gold under pressure, we'll see silver come down, maybe give back 38%, 21%, somewhere in that area, and then move and break above 22. Resistance areas in silver have got to be, the major one's going to be at 22 and then again at 23. This has been Gary Wagner, wishing you as always good trading. We'll talk to you on Monday for another daily update and review. Bye-bye.